federal government debt exceeds 100% of GDP. That is a change that happened as a result of the first round of pandemic stimulus that was passed in the spring of 2020. Is it going to be a problem going forward? I'm Dr. Bill Connerly. I connect the dots between the economy and business decisions. And my own brother raised the question, do we have too much debt? Is it going to cause a problem? I am not going to enter into a political rant about the debt, but I want to give some perspective on it. And I'm going to begin with some data, and this is a picture of federal debt relative to GDP. Now, there's nothing magical about a debt to GDP ratio of 100% or 60%. It's just a number. But looking at trends over time, you can see some changes. Let's focus for a moment on that period of the late 40s, 1950s, 1960s. The debt to GDP ratio went down, but we were not paying off debt. We were not paying off debt. Instead, the economy was booming while we had our deficits under control. Some years we were a little bit in the red, some years a little bit in the black. On average, not much was happening to the total debt burden, but the economy was booming. And there's an important lesson for us that the economy can grow even if it starts with a high level of debt to GDP. And we should take some comfort from that. The debt to GDP number is just a number, but unfortunately, the real burden is even worse than that debt to GDP number I have been showing you, because it only includes the debt that we have borrowed money to fund. The United States government has other obligations for which we have not borrowed money. I'm thinking Social Security and Medicare. We have trust funds, but the trust funds are really tiny, and the burden of future obligations is very, very large. So the actual situation is worse than it appears. So how badly do we actually stand when we look at other countries? Let's take a global comparison, and it's hard to read the labels, but at the far right, that country with nearly 250% debt to GDP ratio, that's Japan. Now, Japan is not a basket case, though its economy is not growing very rapidly. It's got some other challenges as well. But the United States, that solid red column, we're at the high end, but we're not awful. Let's take a closer look at the countries that are near us, and you can see that we are a little bit better than Portugal. Okay, Portugal's maybe not the company we want to be in, but look at the countries with just a little bit less debt to GDP than we have. France, Belgium, Spain, the United Kingdom, and Canada, they're all reasonably healthy countries, and we're in that ballpark. So we're not necessarily a basket case ourselves in the United States. So what could go wrong? The first thing that we often think about when we look at a less developed country with heavy debt is a debt crisis. That occurs when a country is ready to pay off its old bonds, the bonds that have matured. They're going to sell new bonds to pay off the old bondholders and some more new bonds to fund current deficits. And then what if nobody wants to buy those bonds? When I first started studying this, I thought that as a country's fiscal condition worsened, as their debt to GDP ratio went up, that they would gradually have to pay higher and higher interest rates. But that doesn't happen very much. What typically happens is everything is fine, the country is moving along, and then suddenly, boom, nobody wants its debt. They've gotten nervous. So it is impossible for me to pinpoint when the United States might hit a debt crisis. And for those of us in the United States looking at our own situation, looking at our debt levels, looking at maybe challenges that we have in Washington, D.C., it is tempting for us to say, man, why would anybody want to buy U.S. Treasury bonds? But investors look globally, and the question isn't, is the U.S. debt a good buy, but is it a better buy or a worse buy than other countries' debts? So let's say you're a global investor and you're nervous about the United States debt level. What are you going to do? You want to buy Chinese bonds, Japanese bonds, French bonds, UK bonds? One person said, we are the best looking nag at the glue factory. So we see our own problems pretty well, but we're actually not in bad shape at all. So if we're not going to have a debt crisis, what are we likely to have? I believe we're going to have inflation. But first, let me say it's not inevitable that debt leads to inflation. The Federal Reserve could say to the U.S. Treasury, you guys want to borrow money? Go ahead, just pay whatever interest rate it takes to get people to buy your bonds. But that is not what the Federal Reserve has done in 2020 and not what they will be doing in 2021 as the new relief bill, the $900 billion relief bill, is passed. What the Federal Reserve will do is buy those bonds themselves. Where do they get the money to buy those bonds? They print it. Oh, printing money is an anachronism, but it gives the concept. The Fed will print it virtually through thin air and create some electronic assets for itself to use to buy the government's bonds. That is putting more dollars into the economy at a time when we are not increasing our productive capacity. So more dollars chasing fewer goods is the classic definition of inflation, and I believe we're going to have a more inflationary economy. But it's not just inflation that should be on business strategists' thought list. We are going to have a more variable economy, a more up and down economy. The Federal Reserve has pledged that it will not anticipate inflation. It will wait until it actually sees inflation. And I can see some logic there. The Fed has not done very well at forecasting inflation recently, and no private sector forecasters have done very well either. So I don't blame the Fed. It's a difficult job. But we do know there's a long time lag between cause and effect, between the Fed's action to fight inflation and the resulting change in inflation. And if the Fed waits until inflation is actually there, they are not skating to the puck. They are going to be chasing behind it with a long time lag. And I believe that once inflation accelerates, the Fed will hit the brakes, but inflation will keep going up because of that time lag, and then the Fed's going to have to hit the brakes hard. And I believe that will be recessionary. I am not sure when that's going to be. It's hard to predict the timing of the inflation dynamics and then of the Fed's response. I don't think we'll have recession in 2021. Maybe late in 2022, 2023 is quite possible. But at some point, we're going to have a recession because of the inflation and the Fed's late response to the inflation. After the recession, the Fed will say, oops, we're in, well, oops is sort of the kind version of what they're going to say. They're going to say, oh, oops, we're in recession, and stimulate the economy again. So I'm looking for a more variable economy, more ups and downs. Business strategy, I think, should be based upon a couple of fundamentals. One, at some point, we're going to get more inflation. And in general, we are going to have a more volatile economy, more ups and more downs. And that implies that we should have more flexibility. And fortunately, I wrote the book, The Flexible Stance, to talk about it. Now, I'm not here to plug the book per se, but I want to emphasize the value of being ready for the economy to expand faster than expected or to go into a recession that was not expected. So I'm Dr. Bill Connerly. I want to thank you for watching this. Feel free to reach out to me. Check out my newsletter. You can receive it by an email to me or by texting the word econ to 42828. My website is www.connerlyconsulting.com. I'd love to hear from you.